I think one of the things that most people are surprised by is that you can do a 401k and an IRA at the same time.
Okay, interesting.
I think there's a common misconception out there that, if you're covered by a 401k, that you can't do an IRA. Well, you can, but it's limited. So
Hmm.
there's rules around where, there are two different code sections of the IRS, and I hate to get technical, but there's
Hmm.
two different code sections in the IRS tax code.
Yep.
One is for IRAs and one is for 401ks. You
Hmm.
can do them both independently, but they both have their own rules and regulations and stipulations on how much you can put in each year.
Right.
So if you're covered by a 401k plan and you're making, more than, I think it's 180 some $1,000 a year, you can't directly do an IRA, but you can always put into a non-deductible IRA and convert that to a Roth, or put it in and leave it in as a non-deductible IRA. There's lots of different options you have there. You can
Yep.
always do both.
Yep. That's awesome. Yeah, that's one of those things that we get a ton of questions about backdoor Roth, and
Yep.
that's one thing we love to talk about.
Right.
In my mind, it's one of those, and I think Corey, you and I have had this conversation. Like, hey,
Many
while it's
times,
still
many
legal and
times.
about yeah out there, let's do it.
Yeah,
Not saying it's going to be around forever.
it's one of those things that the backdoor Roth, it utilizes two loopholes in the tax code where, the first one being that there's no income limit on a non-deductible IRA contribution. You can make $10 million a year and still put in $6,500 this year into a traditional IRA, or $7,500 if you're over 50. No matter how much money you can make, you can put it into a non-deductible traditional IRA.
Mm-hmm.
Then the second loophole is there's no income limit on converting from traditional IRAs to a Roth. You can make $10 million
Mm-hmm.
a year and convert any IRA money you have from a traditional to a Roth. It's a backdoor Roth. It's simple. It's easy. You can put in, $6,500 a year.
Yeah.
And if you keep doing that every year, for a long time, it builds up.
Yep. One of the things that I have found is people ask, well, what makes a non-deductible IRA? I'm like, well, it's not the IRA, it's the
Function of deducting
way.
it or not. Right.
Yeah, you're right. So how do I make a non-deductible contribution? You just don't
Right.
deduct it.
Exactly.
Because
So
people
you
assume
put,
just because I put money in an IRA, now it's deductible. No, now it can be deducted, but
right.
you determine that when tax time comes.
Exactly. So it's just a traditional IRA, right? So there's really two types of IRAs, traditional and Roth. So if you put money into a traditional IRA and don't deduct it, it's a non-deductible traditional IRA. If you deducted it, then it's a deductible traditional IRA. But you have to keep track on that on a separate form in your tax return. So there's a form 8606 that you keep track of, whether it's, whether you took, if you didn't take the deduction, then you keep track of it there as a deductible or non-deductible traditional IRA contribution. Once you've converted it to a Roth, then you keep track of it as a Roth contribution.
Okay. And so you
it,
can have an IRA with some deductible contributions and some non inside the same IRA?
yes,
Okay.
it gets messy, and I don't recommend it
Yeah.
because you're going to drive your tax person nuts doing that.
Yeah.
I like to try and keep it clean, where if you're going to do a non-deductible traditional, you either keep it non-deductible or convert it to a Roth.
Gotcha.
And there is one major stipulation out there that a lot of people don't know about is if you have other traditional IRAs. So say you take a 401k and you
Yeah.
convert that to an IRA from your old job. Now you have an IRA sitting out there. If you put in a non-deductible traditional IRA contribution,
Yep.
you have to they call it aggregation rules. So you have to prorate the traditional non-deductible and the deducted non-deductible, or the deducted IRA,
Yep.
in a conversion to the Roth. So try saying that fast.
Yeah.
It's really the aggregation rules that if you have any other IRAs out there,
Okay.
it makes the backdoor Roth more complicated.
So what can
So
happen? What's the negative if you don't do it right?
you end up having a mix of deductible and non-deductible that you're not taking credit for. So if you don't keep track of the basis, the deductible basis, then you could end up paying tax when you take the money out on stuff that's non-deductible.
That you've already paid taxes
right,
on.
that you already pay tax on. Right.
Okay. Okay. So it's not a bad idea to do a backdoor Roth if you've got another IRA out there. You just got to be
Careful about
either
it.
converted or be very meticulous about the
right.
tracking the numbers of.
Yes. You have to track it really well, or you can convert all of the other traditional IRA out there.
You know,
And this
and
is
that's great. That's a good point. That's a lot of recommendations I make. I find that, and this is probably true for you too, there's certain recommendations that is just general, like, hey, at least think about this in your last year of residency. One of which being, when you go into practice, you're got a half year at a resident salary and then a half year at an attending salary, give or take. And if you talked to us anytime you're in residency, you probably put some money in your 401k or your 403b in your residency, even if it was just a few percent.
Right.
And I often, and again, this is not necessarily financial advice, everybody's situation is different, but I often tell my graduating residents, let's go ahead and convert that. It's $5,000 in your 401k. This is going to be the lowest tax bracket you're going to be in for the rest of your life this year. Let's convert that to a Roth. And then we can start the backdoor Roth free and clear, no other pre-tax money.
That's the best reason to do it, and I always say, look, it's only $5,000 or whatever it is. Even if it's $50,000, you can do it $5,000 or $10,000 a year for 5 years. You can do any amount in any year you want. There's always the ability to convert from a traditional to a Roth.
Yes.
So if you have $50,000 and you only want to do $10,000 a year, we'll do it for 5 years in a row, and then you're done.
Yeah.
But converting it to a Roth makes more sense tax-wise over your lifetime, because again, a traditional IRA, if you put money in now, you get a tax deduction now. Great. You put in $6,000, you get $1,000 off in your taxes. Great. You saved $1,000. But when that $6,000 grows to $100,000 when you retire, now in a traditional IRA, when you take that money out, you have to pay tax on every single penny of that $100,000.
Yes.
You've just created $20,000, $30,000 of taxable income, or tax on that income that you've created. When you convert it to a Roth, you pay the tax now. Okay, great. You pay tax on $6,000. Fine. When it grows to $100,000, you can take it out with no taxes at all. You've just saved tax on $94,000 of income.
That's great. Yeah.
It's an amazing
way to put it.
The Roth IRA and Roth, even 401k, is just an amazing tool for long-term growth and avoiding taxes, basically getting tax-free growth rather than tax-deferred growth.
Yep.
And a lot of people, and the other misconception out there that I don't even know how it happens is, you get these physicians that are making, 250, 300, 400, 500,000 a year. And for some reason, they've been told along the way, oh, I make too money to be able to put into my Roth. So I'm only putting into my traditional 401k.
Yep.
If your company has a Roth 401k plan, it doesn't matter how much money you can make. You can put money into the Roth 401k plan.
Yep.
And I get that. Oh, I can? Yeah. Put money into your Roth, save you're going to pay tax now. Yes. But that, this year it's 22,500 that you can put into a Roth 401k. Put that in the Roth, let it grow tax free. That way you never have to pay tax on it again.